Hi Sanjay, can you hear me clearly? Sanjay, can you hear me clearly? Can you see the screen? Fixed income securities defining elements. Expanded meaning? Just log in again, Sunil, it'll be fine. There's no option to zoom out. So we'll start with reading number 52 of the level 1 curriculum that will talk about the defining elements of fixed income securities. So to begin with, let's revise that when any corporation or when any individual begins a business or a new industry, we generally require some capital to be put in. That capital can come into the company from two sources. One is equity and other is debt, broadly speaking. So if the new business needs $100 and let's say $50 comes in the form of equity, the agreement with equity holders is that there is no fixed guaranteed return. However, they will get all that is left after meeting the fixed obligations. So the equity holders will be entitled to the profits. If there are no profits, then the equity holders will receive nothing. The fixed income holders, on the other hand, or the debt holders, on the other hand, are guaranteed a fixed return. So these holders do not participate in the profit. They are guaranteed fixed payments and a pre-decided maturity at which their money will be returned. In these next few readings, we'll understand more the characteristics of these fixed income securities issued by governments, corporates, and other bodies, and how the return dynamics of fixed income instruments impact your portfolio. So initially we'll go through some basics and some definitions relating to fixed income securities. Now, the basic feature includes The basic features of a fixed income security include first the issuer, that is generally the corporate who is issuing the security, that is he needs the money for a particular project or some other use. The maturity date at which the principal or the initial investment will be returned to the investor. The par value. The par value is the amount that will be returned at maturity. So this par value is generally $100 or $1,000. If not mentioned explicitly, from the scale in the question you can assume the par value to be $100 or $1,000 per bond. The coupon rate is stated as a percentage of par value. This is the fixed rate of interest that the fixed income investor has been promised. So let's assume 10% annual or 10% semi-annual would be the coupon rate and the coupon frequency, which would imply that 10% of $100, that is $10, would be paid every year. If 10% is semi-annual, then 10 divided by 2, that is 5% into 100 or $5 would be paid every 6 months. So these 4 characteristics and the currency essentially define a fixed income security. So the payments would be made in dollars or euros or some pre-decided currency. So it's fixed income because the coupon rate is guaranteed, the coupon frequency is fixed, and there is a maturity date at which the par value of the bond will be returned. So issuers include corporations, governments, quasi-government entities like municipalities, and supranational entities for instance the International Monetary Fund or the World Bank, etc. Bonds with maturities of 1 year or less are referred to as money market securities, and those with maturities of more than 1 year are called capital market securities. Par value, as we discussed, is the principal amount that will be repaid to the bondholders at maturity. Bonds are trading at a premium if their market price is greater than par value, or they are trading at a discount if their price is less than the par value. So for $100 par value, if the current price of buying this bond is greater than $100, we'll say the bond is trading at a premium and at a discount if vice versa. Coupon is the percentage of par value paid annually or even semi-annually depending on the frequency. Coupon frequency can be annual, semi-annual, quarterly or monthly. There are zero coupon bonds also that will pay no coupon and are pure discount securities. That is, they will pay you $100 at maturity, and today you would pay less than $100 or some discount, and that discount would be an indication of the interest that you have effectively earned. Bonds may be issued in a single currency, dual currency, or with a bondholder's choice of currency, but the currency generally will be predefined at the time of issuance of a fixed income security. So fixed income because most of the characteristics are fixed, the returns or the cash flows, more importantly, from a fixed income security are fixed. Now, bonds are generally issued with indentures and covenants. So a bond indenture or trust deed is a contract between the bond issuer and the bondholders, which defines all the features that we discussed previously and the issuer's or the borrower's obligations. An indenture specifies the entity issuing the bond, the source of funds for repayment, any assets that may be pledged as collateral, so that if the issuer is unable to meet his payments, the investor or the lenders are authorized to sell this collateral and recover their money. Any credit enhancements or any guarantees that other corporations or individuals have given to the debt, so that if the issuer is unable to pay, other guarantors will pay for the debt, or other credit enhancements may at times be mentioned, and any covenants which the issuer must comply. Covenants are those provisions of the indenture that protect the bondholder's interests. They generally can be of two types, that is negative and affirmative covenants. Negative covenants are the restrictions on the issuer's or the borrower's operating decisions. That is, the issuer cannot issue more debt until he has repaid our debt or repaid the previous debt, or he cannot sell the assets that he has pledged as collateral, or he cannot pay dividends until the debt has been serviced, so on and so forth. So negative covenants are restrictions. Affirmative covenants are actions that must be performed. For example, the interest and principal must be paid on time. The EBITDA to interest ratio must be more than 4 times, etc. are affirmative covenants that the issuer must comply with. So generally, the covenants in the indenture essentially is intended to secure the interests of the lenders. There are certain legal and regulatory matters that affect fixed income securities, so you should be aware of. That is, the place where they are issued and traded, who is the issuing entity, is it the government, is it a corporate, how is the funding being done, what is the collateral, what is the credit enhancement. So domestic bonds trade in the issuer's home country and the home currency. Foreign bonds are from foreign issuers but denominated in the currency of the country where they trade. So an Indian corporate may issue a foreign bond, that is, he may issue a dollar denominated bond for US investors. So it is issued by an Indian company, however the bond has payments and guarantees all in dollars. Euro bonds are issued outside the jurisdiction of any single country and denominated in a currency other than that of the currency in which they trade, or other than that of the country in which they trade. So euro dollar bonds would be issued outside the US, so they may be trading in Japan, or they may be trading in Europe or in Britain. However, they are denominated in dollars. So they are denominated in a currency other than the current country in which they trade. So they are denominated in dollars. They are making payments in dollars, but they are trading in Britain. Issuing, and they are referred to as euro bonds. Euro dollar, euro yen, could be any. Euro yen would be yen denominated bonds, but they are trading outside Japan. Issuing entities may be government or a government agency, a corporation, a holding company, a subsidiary, or a special purpose vehicle. The source of repayment for corporates generally are the cash flows from the business. For sovereign bonds, it is the country's taxing authority or the tax collections. For non-sovereign government bonds like municipalities, again the source may be a taxing authority, or for corporates and others it could be revenues from a project or the firm's operations. Securitized bonds are repaid with cash flows from a pool of financial assets. So securitized bonds are generally bonds for whom the coupon and principal payments are coming from the repayments of a loan. So you have issued a loan. As the borrower pays the interest and principal on that loan, the same is passed on to the bondholders. So the bonds are repaid with the cash flows from a pool of financial assets like mortgages, credit card receivables, auto loans, etc. Bonds are called secured if there is a specific collateral that they are backed by. They will be called unsecured if they represent an overall claim against the issuer's cash flows and assets. So unsecured implies that there is no specific asset that can be sold to recover. It will be the cash flows that the issuer is expected to generate that will be necessary for the repayment on this kind of a bond. Credit enhancement may be internal, that is over collateralization. So if you've given a $100 loan and there is a $200 worth of assets that you have kept with you, and that's called over collateralization. Excess spread tranches with different priority of claims, we'll understand all that at level 2 when we study securitization. Or they can be external, that is you have a surety from some other bank or from some other individual, letters of credit, guarantees, etc. Basically ensure that if you don't perform, there is somebody else who has taken the guarantee or who will perform on behalf of the borrower so that the lender's interests are protected. Generally speaking, the interest income on a fixed income security is taxed as ordinary income, while the gains and losses from selling a bond are taxed at the capital gains tax rate. However, the increase in the value towards par of the original issue discount bonds is considered interest income. So, just to explain, generally speaking, the coupons that you receive will be taxed at 30% or whatever is the income tax rate. So, interest income is like any other income. For zero coupon bonds, where there is no coupon, there is no interest income per se, the bond issues at a discount. So, par value may be 1000, but it is issued at 700. Slowly as maturity reaches, the bond will go up to 1000. For such bonds, these increases are treated like interest income and are taxed fully. In United States and in many other countries, interest income from municipal bonds is generally tax exempt at the national level and in the issuer's state. So generally municipal bonds are tax free. You'll understand these regulations better once you understand how the movement and how the valuation of fixed income securities works. Not very important, but we'll go through nonetheless. The most common bond structure is the bullet structure, where coupon is paid periodically and the entire principal value comes at maturity. So for example, a 10% 4-year annual pay, $100 par value bond will generally have cash flows of $10 at the end of t equal to 1, $10 at t equal to 2, $10 at t equal to 3, and $110, that is the principal plus coupon, at t equal to 4. This is called the bullet structure of a bond. A bond with an amortizing structure repays part of its principal at each payment date. So at each of these 4 coupon payment dates, a part of the principal is also retired. So in an amortizing structure, the payment would be something like 20, 30, 50 or 60, so that there is not one big lumpy payment at the end. Some amount of the principal is retired with every coupon payment. A fully amortizing structure makes equal payments throughout the bond's life. A partially amortized, so this equal payment will comprise some part interest, some part principal. A partially amortizing structure has a balloon payment at maturity, which repays the remaining principal as lump sum. So partially amortizing means some principal is retired, but a lot of it is still retained for maturity when again a balloon payment comes, like in the bullet structure. A sinking fund provision requires the issuer to retire a portion of a bond issue at specified times during the bond's life. So some part of the principal has to be repaid at predefined milestones. So it may be a 4-year bond, but entire principal will not be paid at maturity. After 1.5 years, 2.5 years, some part of the principal has to be retired according to the provisions of the sinking fund. Floating rate notes have coupon rates that adjust based on a reference rate, such as the London interbank offered rate. We'll study this in more detail. So these notes essentially have coupons that are varying. So it's not a fixed 10% coupon. The coupon will still be a percentage of the par value, that is 100 or 1000, but that percentage will vary according to some variable reference rate. Other coupon structures include step-up coupon notes. So herein coupon keeps going up after a particular period. Credit-linked coupon bonds, where the coupon is dependent on the credit quality of the borrower. As the credit quality deteriorates, more coupon has to be paid. As the credit quality improves, less coupon has to be paid. Payment in kind bonds, deferred coupon bonds, where coupon is paid later. Index linked bond, where coupon is dependent on the performance of an index, an equity market index or some other index, or an inflation index many a times. So as inflation goes up, the coupon goes up, and vice versa. Some fixed income securities even have equity linked coupon payment. So any kind of a structure potentially can be created as long as there is an issuer and an investor in that structure. So there can be many cash flow structures. You don't need to know the details of each one of them. Just know that there can be various types. The bullet is the most common, and there are amortizing and other more complicated structures also that can be created. A lot of bonds have contingency provisions and embedded options. Embedded options in a bond structure will benefit the party who has the right to exercise that option. So we'll study options in more details when we study derivatives, but understand, call options are generally kept with the issuer. That is, the issuer can call the bond back by paying a fixed lump sum to the investor. He can extinguish the bond or call the bond back. Put options and conversion options are generally with the investor or the bondholder. So the investor can sell the bond back to the issuer, or he can convert the bond into equity depending on the equity price, etc. So some options in the bond structure benefit the issuer, like the call option, and some option, generally like the put option and the conversion option, benefit the bondholder. So call options allow the issuer to redeem the bonds at a specified call price. Put option allows the bondholder to sell the bonds back to the issuer at a specified put price. Conversion options allow the bondholder to exchange bonds for a specified number of shares of the issuer's common stock. We'll study more about convertible bonds at level 2. However, these are some more structures that can be added to a regular bond cash flow or a regular bond agreement. So that was about the basic features or the defining elements of fixed income securities. We'll study more about the characteristics and valuations in the coming readings. more investors, Sunil. You can attract investors from other countries. Reading 53 of the level 1 curriculum will talk about the issuance, trading and the funding in fixed income markets. So global bond markets can be classified by various types. They can be classified by the type of issuer. So it can be the market for government bonds or government related bonds, or it can be a market for corporate bonds. So corporates can be financial entities, that is banks, non-banking, financial corporations, etc., or non-financial entities like manufacturing companies. They could be securitizations or securitized assets that we'll study more about in the coming slides and at the level 2. Bond markets can be classified by credit quality. Investment grade is generally from safer or issuances from companies who have more stable and more healthy cash flows, whereas non-investment grade markets or issues are from less lesser quality corporates or lesser quality cash flows. They can be classified by maturity. So money markets are generally less than 1 year, capital markets are more than 1 year. They can be classified by fixed rate bonds or floating rate bonds. They can be classified by the currency and geography, so domestic bonds, foreign bonds, global bonds, euro bonds, bonds issued in US dollars but outside the US, in yen but outside Japan, etc. Developed market bonds, emerging market bonds, etc. Other classifications could be indexed bonds, tax-free bonds, etc. So there can be many classifications within the bond market that we have seen. An important concept is that of interbank offered rates as a reference rates. So interbank lending rates are the rates promised when one bank lends to another bank, or it is the rate of interest charged by one bank and paid by other bank when there is interbank borrowing and lending happening. So London interbank offered rate is generally a euro dollar rate. That is, it is the rate on dollar deposits made outside the US or dollar deposits made in Britain, in Europe. So this rate is essentially a dollar rate. It represents a dollar borrowing, only it has been made outside the US. Now this rate is posted daily. This rate can be for a one-day borrowing. So there's a bank A and a bank B. Bank A wants to lend to bank B and bank B wants to deposit some money in bank A. So the bank B is depositing the money So bank A, for instance, will post daily rates that the bank is offering on deposits. So for a 60-day deposit, the bank is offering 2%. For a 100-day deposit, the bank is offering 2.1%. For a 5-year deposit, the bank is going to give an annual rate of 2.6%, so on and so forth. Banks accept deposits every day. The rate is the rate that the bank is offering for accepting deposits in dollars for various maturities. The rates are always annualized, and these rates will change daily. So for a 60-day deposit today, I may be charging 2%. Tomorrow I may charge more or less depending on the demand and supply of money. So these interbank lending rates, or these offers, are only for other banks. That if another bank deposits, this is the rate that bank A is offering. Similarly, all banks will post their offer. That is, if you deposit with me, I offer this much rate. We take the average of all 60-day interest rates offered, and that will be the 60-day LIBOR, or the 60-day interest rate, and this number will change every day. This LIBOR rate, that is the rate on euro-dollar deposits, is often used as a reference rate for floating rate debt. As we will see, the coupon will keep varying as these rates change. An appropriate reference rate is one that matches a floating rate note's currency and frequency of resets. So if it's a 6-month floating rate bond, so every 6 months the coupon is paid based on the 6-month LIBOR. So the appropriate reference rate will be the 6-month US dollar LIBOR for a semi-annual floating rate note issued in the US, or issued in US dollars. So if I have a semi-annual bond, that is, the bond pays coupon every 6 months, and the coupon is not fixed. Coupon is based on a reference rate. So what will be a good reference rate for this bond? It will be the 6-month LIBOR. So after every 6 months, we will look at the 6-month LIBOR. Whatever is that rate is the coupon that will be paid to the investor of the bond. If the 6-month LIBOR goes up, the investor will get more coupon. If the 6-month LIBOR comes down, the investor will get less coupon. How are bonds issued? Primary market is when new bonds are issued for the first time through a public offering or a private placement. A public offering is generally done using an investment bank. It may be underwritten, that is, if enough investors do not participate or do not provide the investment, then the investment bank will itself subscribe and provide the investment for the issue, with the investment bank or syndicate purchasing the entire issue and selling the bonds to dealers, or on a best efforts basis. In a best efforts basis, the investment bank doesn't guarantee. However, he sells the bonds on a commission and he markets the bond to all investors on behalf of the corporate that wants to raise debt or raise money. Public offerings can also take place through auctions, which is normally the method used to issue government debt. So the debt is placed with the investor who is willing to accept the lowest yield or the lowest return. So whoever bids the lowest yield or whoever bids the highest price for the bond is who the bond is given to, that investor. In a private placement, an entire issue is sold to a qualified investor who gives the debt or who invests the money, and we issue the bonds to that investor or a group of investors, which are typically large institutions. Bonds that have been issued previously can also exchange hands. So I may have invested in a bond and now I may require money for some other purposes, so I can sell the bond to some other investor in the secondary market. While some bonds trade on exchanges, most of the bond trading happens in the over-the-counter market or in dealer markets. Spreads between bid and ask prices. The dealer market, please recall, the dealers post bid, that is the price at which they will buy, and ask, that is the price at which they will sell the bond. These bid-ask spread are the source for the dealer's compensation, are generally narrower for liquid issues and wider for less liquid issues, just like in equities or any other market. Trade settlement is typically 3 days after the trade for corporate bonds, 1 day after the trade for government bonds, and the same day for money market instruments. That is how quickly the transfer happens electronically or in physical form. The issue or the bonds get transferred from your name to the other person's name and you receive the cash. So it takes 3 days for corporate bonds and 1 day or same day for government and money market instruments. Government related bond issuances are very common. Just like corporates need bonds, governments also need debt for various purposes, for infrastructure creation, social purposes and other expenditures. So sovereign bonds are issued by national governments and are backed by their taxing power. They may be denominated in the local currency or in the foreign currency. Non-sovereign government bonds are issued by governments below the national level, such as provinces or cities, and may be backed by the taxing authority or revenues from a specific project. So municipalities also may issue bonds for a particular highway construction, and once that highway is completed, the toll from that highway is used to repay the debt on that project. Agency or quasi-government bonds are issued by government-sponsored entities. For example, the Freddie Mac, Freddie Mae, Fannie Mac, or the government housing finance agencies in the US have historically been sponsored by the government, so they are helped by the government to meet their cash flow obligations to the lenders in case they are unable to service them on their own. Supranational bonds are issued by multilateral agencies, for example, the World Bank, the International Monetary Fund. So they also need money for development activities all over the world, and you can invest in their bonds as well. Generally, these are also high quality bonds and are another source of investment for bond investors. Debt issued by corporations includes bank debt. So you raise money directly from the bank. It can be commercial paper, wherein instead of borrowing from the bank, who in turn is borrowing from retailers or depositors, the company can directly go to the depositors. So for bank debt, the corporation goes to the bank and the bank takes it from the depositors through essentially bank earns a spread. So the corporate may say, why give the bank a spread? The corporate can directly go to the depositor. Generally only high quality corporates are able to do this. They can issue bonds. So corporate bonds are generally placed with institutional investors, insurance companies, mutual funds and other entities, and medium term notes, which can also be bought by various investors. Bank debt includes bilateral loans from a single bank, or it can be syndicated loan where multiple banks come in and lend to a particular corporate. Commercial paper is a money market instrument issued by corporations of the highest credit quality. As I explained, they go to the depositors directly. Corporate bonds may have a term maturity structure. That is, all bonds in an issue mature at the same time, or they may have a serial maturity structure. That is, the bonds mature on a predetermined schedule. That is, some bonds mature first, others mature later, and can also have a sinking fund provision, as we discussed, where a part of the bond issue has to be retired at specific periods in time. So let's say I borrowed $100 by issuing 10 bonds. So in a term maturity structure, all 10 bonds and $100 matures after 5 years. In a serial maturity structure, there's a predetermined schedule according to which some bonds will first get matured and then the others, and similarly a sinking fund provision. Medium term notes are again issues that can be structured to meet the requirements of various investors. Short-term funding alternatives for banks are many. So banks generally lend to corporates for short-term, medium-term, long-term. The bank's main source of funding is the depositors' capital, that is the retail and wholesale deposits that they receive. So the first short-term funding alternative is customer deposits, that is checking accounts, also called current accounts, savings accounts, and money market mutual funds. Banks can also issue negotiable certificates of deposits. Certificates of deposits are like fixed deposits, which may be sold in the wholesale market, that is to insurance companies or mutual funds. They may accept big deposits from these institutions at a negotiated rate at which the institution may be willing to put money in the bank. Central bank funds market. So banks may buy or sell excess reserves deposited with their central bank. So they can essentially go and borrow and lend money to the RBI or the Federal Reserve or the central bank. And banks can make unsecured loans to one another for periods up to a year. These are interbank funds. The LIBOR rate that we discussed essentially is an interbank rate, that is the rate charged by one bank for lending to another bank. Finally, a very important concept of repurchase agreements. So a repurchase agreement is a form of a short-term collateralized borrowing in which one party sells a security to another party and agrees to buy it back at a predetermined future date and price. So it's party A and party B. Party A has an asset. He agrees to sell it to B for $10 and then buy it back from B 2 days later by paying him $10.1. So he has sold with an agreement to buy it back at a pre-decided rate at a pre-decided time. This $0.1 that B is earning additionally is like the interest on the borrowing. This implicit interest rate in a repurchase agreement that can be easily calculated by seeing what is the price at which the borrower is buying it back is referred to as the repo rate or the repurchase rate. The repo margin or haircut is the difference between the amount borrowed and the value of the security. So if this asset is worth $15 and I'm borrowing $10, then the haircut is 50%. That is the difference between the amount borrowed and the value of the security. Repurchase agreements are an important source of short-term financing for the bond dealers. If a bond dealer is lending funds instead of borrowing, the agreement is known as a reverse repo. That is, he has sold the asset and he will buy it back. If he is buying the asset and paying the money, that is, he is lending, then the transaction is referred to as reverse repo. The first transaction is the repo transaction, wherein he is selling the asset, that is borrowing, and then buying it back, that is repaying after a pre-decided time at a pre-decided price. Very important, repurchase agreements, agreement to sell and buy back. Essentially a borrowing or essentially a lending, that is a collateralized lending with that asset that you are buying and selling as the collateral. One of the most important readings in the review of fixed income securities and for the CFA curriculum is reading 54, which will talk about Introduction to Fixed Income Valuation. Please make sure that you have your calculators handy before you go ahead with this review. So, to begin with, we'll quickly revise what a fixed income security is. Essentially speaking, it has a fixed coupon, a fixed par value, and a fixed date of maturity. Hence, it's called a fixed income. So the cash flows are fixed. The coupon can be annual or semi-annual or quarterly. And the investors are guaranteed this stream of cash flows, which is why it is called a fixed income security. We will now try to understand how to put a value to a bond or a fixed income security using various methods. So, the price of a bond is the present value of its future cash flows discounted at the bond's yield to maturity. So, like for any other asset, like we did in the case of equity valuation, once the cash flows are known, and it's easy in the case of fixed income security since there is no real estimation that needs to be done. If we assume there will be no default, that the issuer will honor his obligations, then the cash flows are pre-decided. So we need only estimate the discount rate to compute the price of the bond. That discount rate is referred to as the bond's yield to maturity. So yield to maturity is the rate at which, if we discount each cash flow of the bond, the discounted back value of the cash flows will equal to the market price of the bond. So for an annual coupon bond with n years to maturity, the price will be calculated as the cash flow in the particular year divided by 1 plus YTM to the power the year in which that cash flow is coming. For a semi-annual coupon bond, the yield to maturity is generally also assumed to be semi-annually compounded. So the price will be calculated as the cash flow upon 1 plus YTM by 2 to the power into the year in which the cash flow is coming. So we'll understand this better when we do examples, but if we've done the review on time value of money, essentially calculating the value of a bond given the yield to maturity should not be a big problem. So calculate the value of a 4-year $100 par 8% annual coupon bond with discount rates, or you can say yield to maturity, of 8%, 6% and 10%. So let's first depict the cash flows from the bond. So we are computing the price of this bond at t equal to 0. It is an 8% annual coupon bond. So at t equal to 1, we are expected to get 8% of $100, that is $8. At t equal to 2, similarly, and at t equal to 4, we will get the $8 coupon plus the $100 par value at maturity. We'll first discount it at the rate of 8%, so it will be 1 upon 1 plus 0.08, 1 plus 0.08 to the power 2, so on and so forth, 1 plus 0.08 to the power 4, and then we can similarly do it with 6% and with 10%. So of course we will use the time value of money sheet of the calculator to make our calculations simple. So please take out your calculator, press 4 and press N since there are 4 cash flows and 4 periods. Enter 8 and enter I by Y since the discount rate is given to be 8%. Ignore PV, press 8 and press PMT. Press 100 and press FV since that is the additional value coming at maturity, and press compute PV. We see the PV comes out to be minus 100. This is what is referred to as a par bond. If the coupon of the bond is equal to the yield to maturity, the coupon rate is 8% and the yield to maturity is also 8%, then the price of the bond is equal to its par value. Let's similarly do the calculation for a 6% discount rate. So if we press 6 and we press I by Y and then we compute PV, we see the PV or the price of the bond or the discounted back value of these cash flows now comes out to be 106.93. So if the coupon rate is greater than the yield to maturity, or the yield is less than the coupon rate, then the price of the bond will be higher than the par value, and this will be referred to as a premium bond. If we enter 10 as I by Y, that is increase the discount rate to 10% and then compute PV, we will see the price of the discounted back value comes out to be $93.66. This is referred to as a discount bond, which is when the coupon is lesser than the yield to maturity or the yield is greater than the coupon rate of the bond. So at 8% yield and 8% coupon, we get the price as equal to par value. At a lower yield, we see that the bond trades at 106.9, that is a premium to par, and at 10% we see that the bond trades at a lower rate, that is a discount to par value. Now similarly, let's compute the price of a 3-year semi-annual bond with a 6% coupon rate and different yield to maturities. So once again, let's get our calculators, and it's a semi-annual bond now. So the time to maturity is 3 years. So we're computing the value at t equal to 0. The coupons are coming at 0.5, 1, 1.5, 2, 2.5, and at the end of 3 years. 6% is the coupon rate. So with a $1,000 par value, you will get 6% upon 2 into 1,000, that is $30 as coupon. So we get $30 at t equal to 0.5, another 30 at t equal to 1, so on and so forth, and 1030 at t equal to 3. With the yield to maturity of 6%, this will be discounted back by 1 plus y by 2. At t equal to 1 will be 1 plus 0.03 square. Finally, 1 plus 0.03 to the power 6. Of course, we don't have to manually do this calculation. We can easily do it with the help of our TVM sheet. We'll enter N as 6, PMT as 30, I by Y as 3 to begin with, that is 6 by 2, because please note now there are 6 periods, and this I by Y is the discount rate per period or the interest rate per period. Interest rate is 6% annualized, but 6% is the annualized, and it's a 3-year bond. So in each of the 6 periods, we are getting a 3% yield, or a discount rate has to be 3%, that is 6 by 2. PV is what we want to calculate. FV is 1000, assuming $1,000 par value. So let's calculate. Press 1000 and press FV. Please note it doesn't matter in which order you enter the variables. Press 30 and press PMT. press 3 and press I by Y, press 6 and press N and compute PV. We see it again comes out to be $1,000 as the yield is equal to the coupon. If the yield doesn't change as time passes, that is from 6 periods as N becomes 5, and I compute PV, it will still remain 1,000. As N becomes 2, that is only 1 year remaining to maturity, and I compute PV, it will still remain 1,000 as we can see. So for a par bond, the price of the bond remains equal to the par value as long as the yield to maturity is the same as the coupon of the bond. For the same bond, if we input a yield to maturity of 12%, which means a semi-annually compounded rate of 12 by 2, that is 6%. So just press 6 and press I by Y and compute PV. Put N back to 6 and compute PV. You will see that the price of the bond will now come out to be equal to 852.48. If the yields remain at 12% with a coupon of 6%, you will now see that as time passes, so if N becomes 5, that is 2.5 years, and we compute PV, the price will keep going up 873.6. As N becomes 4 and I compute PV, price becomes 896. Just 6 months before the maturity of the bond, that is just one period away, so press 1 and press N and then compute PV. You see that the price of the bond becomes 971.69, which is logical because at maturity the bond will give us $1,000. So we are discounting it by a high rate. When the time period is large, the discounted back value will be lower. But as we reach maturity, the value of the bond becomes closer to its par value. As N becomes 0, so if you press 0 and you press N and then you compute PV, that is at maturity, the value of the bond will be equal to its par value. So this is called the pull to par phenomena. That is, if the yields remain constant at a higher level throughout the life of the bond, then the price of the bond slowly gets pulled up to its par value. Similarly, you can verify that for a bond issued at a discount, if the yield to maturity was 1.5, so if you press 1.5 and press I by Y, enter N as 6 again and compute PV, the bond will initially be trading at a premium, but as time passes, the value of the bond will come back equal to $1,000. You can press 1 and press N and compute PV and verify that a premium bond will amortize down to par value, a discount bond will amortize up to its par value at maturity. This is called the pull to par phenomena for all bonds. That is, the value of a bond at maturity is close to or rather is equal to the par value. The graph depicts that. So what we can say is that a bond's price and yield to maturity are inversely related. An increase in yield to maturity decreases the price, and a decrease in yield to maturity, as we just saw, increases the price. A bond will be priced at discount to par if the coupon rate is less than its yield to maturity, and a premium if the coupon is greater than the yield to maturity. Prices are more sensitive to changes in yield to maturity for bonds with lower coupon rates and longer maturities, and less sensitive to changes in yield to maturity for bonds with higher coupon rates and shorter maturities. So we will study that in more detail when we study duration. Basically, what you can say is that the duration of the bond is greater for lower coupon and longer time to maturity, and vice versa. A bond's price moves towards par value as time passes and as maturity approaches. Another very important concept is that of bond pricing using spot rates. So let's first understand what spot rates are. Spot rates are market discount rates for single payments to be made in the future. So if $100 is coming at t equal to 1, or if $30 are coming at t equal to 4, and $60 are coming to me at t equal to 7, then the first $100 will be discounted back by the 1-year rate. The $30 at t equal to 4 will be discounted back at the 4-year spot rate. Please note the rate is annualized. So it will be 1 plus r4 to the power 4. The cash flow coming at t equal to 7 will be discounted back by the 7-year rate. Please note that it is not necessary that R1, R4, R7 need all be the same. The yield to maturity of a bond is a similar rate that is applied to all cash flows of the bond. However, for single payments coming at different points in time, it is not necessary that each payment need always be discounted back by the same rate. So the discount rate for the 1-year maturity cash flow may be different from the discount rate for a 4-year maturity cash flow, and so on and so forth. The spot rates at any point in time are represented in a curve called the term structure or the yield curve or the spot curve. So the yield curve represents the discount rates for various maturities. So for t equal to 1, that is cash flows coming 1 year later, maybe the rate of interest is 5%. For cash flows coming 2 years later, maybe it's 6%. For cash flows coming 3 years later, maybe it's 6.5%, so on and so forth. If the spot rates are given, then again we can compute the price of the bond by explicitly projecting the cash flows and discounting each cash flow, that is each coupon or the coupon plus principal, by the corresponding spot rate, that is by the rate of interest the market is discounting cash flows at that maturity. This will be a more lengthy process wherein each cash flow will have to be individually discounted, and then all discounted back cash flows will have to be summed up to achieve the no arbitrage price of the bond. For example, given the following spot rates, calculate the value of a 4-year 10% annual coupon bond. The 1-year spot rate is given to be 2%. The 2-year spot rate is given to be 3%. The 3-year spot rate is 4%. And the 4-year spot rate is 5%. So it's a 10% annual coupon bond. Please note the par value is not given. You can assume it to be $100 or $1,000 and go ahead and solve. Generally there will be 4 options, so that will help you decide whether it should be $100 or $1,000. If it's in the range of hundreds, then 90 or 110, that means the par value is 100. If it's 990 and 1050, etc., then the par value is $1,000. Let's assume $100 for the time being. So $10 at t equal to 1, $10 at t equal to 2, $10 at t equal to 3, and $110 at t equal to 4. At t equal to 0 is when we are calculating the price of the bond. The first cash flow will be discounted back at 2%. Please note rates are always annualized. So it will be upon 1 plus 0.02. Second cash flow will be discounted back by 3%, but it's coming 2 years later, so 1 plus 0.03 to the power 2, 1 plus 0.04 to the power 3, and 1 plus 0.05 to the power 4. We sum it all up to compute the price of the bond. Please note, if the yield to maturity was given, we could have simply discounted it by just one rate, that is the yield to maturity. So you can say that the yield to maturity is something like a blended average of these individual rates that also gives us the same answer as the price of the bond. So both methods are correct for computing or discounting back the cash flows to achieve the price of the bond. Please verify, you can do the calculation at your time. If you assume $1,000 par value, then the discounted back value will come out to be 1186.17. In our $100 example, it would be 118.617. Another popular concept is that of the full and the flat price of a bond. The full price of the bond is also called the dirty price, and the flat price is also called the clean price of a bond. The price that we have been calculating hitherto, the discounting back using spot rates or the yield to maturity, is the full price of the bond or the dirty price of the bond that we have been calculating hitherto. The full price includes interest accrued between coupon dates. The flat price or the clean price is the full price. So we first calculate the full price and then we subtract the accrued interest to compute the clean price. The accrued interest is calculated as the coupon payment multiplied by the portion of the coupon period from the previous payment date to the settlement date. So for instance, if we are talking about a 10% annual coupon bond, then the coupon payment with a par value of $100 will be equal to $10. The coupon payment is $10. The portion of the coupon period from the previous payment date to the settlement date. So the previous payment date, let's assume, was t equal to 2. The settlement date is, let's say, 30 days into the future. So it is 2 years and 30 days, that is the settlement date. And the next payment is going to come at t equal to 3. The year has 365 days. So if the settlement date is 30 days later, then the accrued interest will be calculated as the portion of the coupon period from the previous payment date, that is t equal to 2, to the settlement date, that is 30 days, divided by 365, that is the portion of the $10 coupon that has been accrued. This is called the accrued interest. So the time from the settlement date to the previous payment divided by the time between coupon payments. If it was semi-annual, this would probably be 180 or 182, multiplied by the coupon amount. The clean price or the flat price is calculated as the price that we calculated minus this accrued interest. Hence the full price can be written as the flat price or the clean price plus the accrued interest. The methods for determining the period of accrued interest include actual days, that is, actually how many days have passed, including Saturdays and Sundays, divided by the actual time between coupon payments, that is 365 days or whatever is the length of the year. Other conventions include a month is rounded off to 30 days and a year is rounded off to 360 days. So if 2 months have passed, it will be 60 upon 360. This is a convention that is typically used for corporate bonds. So once again, the accrued interest is the coupon amount multiplied by the time elapsed since the last coupon divided by the total time between coupon dates. An 8% bond makes coupon payments on 20th July and 25th December and is trading with a yield to maturity of 5%. The bond is purchased and will settle on 15th September when there will be 4 coupons remaining until maturity. calculate the full price of the bond using actual days. So it's an 8% bond that makes semi-annual coupon payments. So once on 20th July, and then on 25th December. The yield to maturity is given. It's 5%. The bond is purchased and will settle on 15th September. So the purchase is going to happen on 15th of September, and there will be 4 coupons remaining until maturity. Starting on the next 25th December, there will be 4 coupons. Calculate the full price of the bond using actual days. Now, one way is to simply project the individual coupon payments and discount each of them back till 15th of September to compute the full price of the bond. A simpler way that will help us easily use the calculator would be to first compute the price of the bond at t equal to 0. There are 4 payments pending at t equal to 1, t equal to 2, t equal to 3, t equal to 4. Let's come back to the beginning of this period, which will be t equal to 0. Even though we need to calculate the price at 15th of September, let's first calculate the price at 20th of July. Once we've computed that, we will compute the future value of that amount and raise it up to get to the value as of 15th of September. So let's first enter n as 4, since there are 4 coupon payments pending, I by y as 2.5 or 5 by 2 since it's a semi-annual bond, PMT as 4%, so enter PMT as 4, and or rather $40 since it's let's assume $1,000 par value, and FV as 1000. So let's compute. Press 4 and press press 4 and press N, press 2.5 and press I by Y, press 40 and press PMT, press 1000 and press FV, and compute PV. We see the PV comes out to be 1046.42. We'll store this in the memory register 1. However, this is the value on 20th of July. We need the value as of 15th of September. So we've discounted it back a little extra. So to compute the value as of 15th of September, we see that between 20th of July and 15th of September, there's 27 days. So whatever was that PV, we will compound it back up at the rate of 2.5% to the power 27 by 365, rather July, August, September. There will be 57 days, not 27, to the power 57 by 365 to compute the value as of 15th of September. So we have the PV. We'll first compute 1.025 to the power 57 by 365. We'll store this in memory register 2. Compute 57 divided by 365. Store it in memory register 3. Recall 2 y to the power x. Recall 3. Multiply it with what we stored in memory register 1. Once again, recall 2 y to the power x. Recall 3. Multiplied it with what we stored in memory register 1. Recall 2 y to the power x. Recall 3. Multiplied it what we stored at memory register 1. Please verify. The full price will come out to be 1060.511. Yes, slight error, we'll do it just once again. So the PV is what we have calculated as of 20th July. However, the settlement is happening However, the settlement is happening on 15th of September. So we have over discounted it as of now. We've discounted it back the whole period, that is at t equal to 0. So we need to now compound it back up to 15th of September. The yield is given to be 5%. So whatever is the PV, we will raise it back up at the rate of 0.025 or 2.5%, that is 5 by 2, to the power 20th July to 15th September is 57 days, divided by the time between the coupon payments, which in this case is 158 days. So it will be PV into 1 plus 0.025 to the power 57 divided by 158. Which will come out to be 1065.88. Please verify the calculations once. The next concept that we'll study is called matrix pricing. So matrix pricing is a method used to estimate the yield to maturity for bonds that are not traded or are infrequently traded. So the yield is estimated based on the yields of traded bonds with the same credit quality. If these traded bonds have different maturities than the bond being valued, then we apply linear interpolation to estimate the subject bond's yield. We'll understand this better with an example. So Amit is estimating the value of a non-traded 6% annual pay AA plus rated bond that has 6 years remaining until maturity. He has obtained the following yields to maturity on similar corporate bonds. So on AA plus rated bonds, with a 5-year annual pay maturity and a 7% coupon, he's found the yield to maturity to be 6.7%. Similarly, for 7-year bonds, he has two 7-year bonds wherein he's found the yields to be 7.4 and 7.8%. Please note, the coupon doesn't matter. The yield to maturity reflects the current interest rates and the current return expectations from the bond. The price will automatically adjust if the coupon is higher or lower. It generally will not affect the yield. So we need the yield for a 6-year non-traded bond. So essentially we need a 6-year AA plus yield. That is, bonds of AA rating are giving what return is what we want to find out. That bonds with a maturity of 6 years with a rating of AA plus are giving what yield to the investor. So we don't exactly have a 6-year bond. If we had a traded 6-year bond, our problem would have been solved. We don't exactly have that, but we have some related bonds. So we have two 7-year bonds and one 5-year bond. So what we'll do is we'll first calculate the average 7-year yield, which comes out to be the average of 7.4 and 7.8, that is 7.6. And then we have the 7-year yield now, and we have the 5-year yield. So to calculate the 6-year yield, we will again interpolate, that is 7.6 plus 6.7 divided by 2, which will come out to be 7.15%. Once we have the yield, we know the number of years, we know the yield now, we know the coupon, we know the future value, and you can compute the present value. That will come out to be minus $945.44. So the step 2 was the main calculation, which gave us the yield of the 6-year AA plus rated bond, with which we could calculate the price of the bond. All the other parameters were known. In a similar manner, the matrix method can be used to estimate the spread. What the spread is and what spreads are, we'll study in more detail in the coming slides. So consider the following market yields. For a 4-year US Treasury bond, the yield to maturity is 1.33%. And for a 4-year A-rated corporate bond, the yield to maturity is 2.52%. So we can calculate the spread, that is the extra yield that the corporate bond has to give over and above the Treasury bonds, as 2.52 minus 1.33%. Similarly, 6-year Treasury bond has a yield of 2.01 and a 6-year A-rated bond has a yield of 3.28. Similarly, for the 6-year, we can calculate the spread as 3.28 minus 2.01. For the 5-year Treasury bond, we know the yield to maturity. We are required to estimate the yield on a newly issued 5-year A-rated corporate bond. So again, we can compute the average spread. So for the spread for the 5-year bond, we can take the average of the 4-year and the 6-year bond. Please note, it doesn't always have to be an average. In this case, because we wanted the 5-year and 4 and 6 is exactly half. If you are given a 2-year bond and a 6-year bond, and we were asked for a 5-year bond, then we won't just take an average again, because if the 4-year bond was asked, you could have taken an average. You will have to do a linear interpolation. So do between 2 to 6, there are 4 years. You want the third year. So it will be the spread of the 6th year bond minus the spread of the 2-year bond multiplied by 3 by 4 plus the spread of the 2-year bond. That will be the spread of the 5-year bond. In our example, it's been pretty straightforward because we wanted the 5-year bond and the 4th and the 6th was given. I'm just explaining that in case the spread of the 2-year bond is given, the spread of the 6-year bond is given, and you're required to estimate the spread of the 5-year bond. So you would have to do a linear interpolation. That is, see the spread of the 6-year bond minus the spread of the 2-year bond. That is the increase in spread that has happened over 4 years, because 2 to 6 is 4. We want to go only 3 years forward because we want to reach the 5th year. So we'll do 3 by 4 plus the spread at S2. That is what the spread will be at year 5. Once we have the spread, we can add the yield to maturity of the treasury bond and compute the yield of the A-rated corporate bond. So 5 is the midpoint of 4 and 6. Hence we could take an average and then just add this with the treasury to get our answer. If it is not an average, then you would have to do a linear interpolation as I just explained. The effective yield of a bond depends on its periodicity or the annual frequency of coupon payments. For an annual pay bond, the effective yield is equal to the yield to maturity. For bonds with greater periodicity, the effective yield will turn out to be greater than the yield to maturity. So a yield to maturity for a semi-annual bond is 2 times the semi-annual discount rate. However, the effective yield will be greater than the yield to maturity for a semi-annually compounded bond. Let's do an example and understand. ABC Incorporated's bond is quoted with a yield to maturity of 10% on a semi-annual bond basis. What yield should be used to compare it with a quarterly pay bond and an annual pay bond? So, if a bond gives me 10% on a semi-annual bond basis, what this essentially means is that it is giving me 5% every 6 months. So if I had $1 invested in this bond to begin with, after 6 months it would become 1 into 1 plus 0.05, and after 1 year it would again go up by 1.05 to give me a total amount at the end of the year as $1.05 into 1.05, that is $1.1025. Whereas if an annual YTM is 10%, then I would just get 10% at the end of the year. So $1 on an annual YTM of 10% would just become 1.1. So 10% on a semi-annual bond basis is equal to 10.25% on an annual basis. So for an annual pay bond, the bond should give 10.25% so as to be equal to a semi-annual bond of 10%. For a quarterly pay bond, it will be different. If a quarterly pay bond is giving me a yield of X%, then essentially I'm getting X by 4 every 3 months, or my $1 would become 1 plus X by 4 to the power 4 by the end of the year. In the case of a semi-annual bond, the $1 had become 1.1025 at the end of the year. So can we compute what quarterly compounded rate or what quarterly bonds yield would be equal to a semi-annual yield of 10%? Semi-annual yield of 10% means $1.1025 at the end of the year. For a quarterly bond, what this translates into is the fourth root of 1.1025 minus 1 multiplied by 4. So let's calculate. 1.1025 to the power 0.25 minus 1 multiplied by 4. That is 9.87%. So if a quarterly bond gives us 9.87% also, a quarterly compounded bond, then also we will get $1.1025 at the end of the year. So a semi-annually compounded bond of 10% is equal to 10.25% annual, or you can say it is equal to 9.87% quarterly compounded. Please verify. This will be 10.25%. So an annual 10.25 or a semi-annual 10 or a quarterly 9.88 all mean the same. So we studied the yield to maturity. We'll now study certain other yield measures. But before, please note that the yield to maturity also that we've calculated normally use the stated coupon payment date. So the date is 29th December, then we'll take it as 29th December. It is possible that at 29th December we may not get the coupon because there was a holiday, a bank holiday, or for some other reason. So true yield should theoretically account for the coupon that are delayed by weekends or holidays and hence may be slightly lower than the street convention yield. So it's just a minor adjustment that can be done theoretically. The other yield measures that we will study is first the current yield, that is defined as the ratio of the bond's annual coupon payment to its price. A simple yield adjusts the current yield by using a straight line amortization of any discount or premium. So never mind the simple yield, just focus on the current yield, that is the annual coupon upon the price. For a callable bond, we may need to calculate a yield to call that may be calculated using the call dates and prices. The lower of the yield to call, and if there are many call dates, then the lower of all the yield to calls and the yield to maturity is called the yield to worst. So yield to worst is the worst case yield that you will get from the bond in case the worst case scenario plays out and the ball gets called back or whatever happens. So let's do a couple of questions and understand this. Consider a 10-year $100 par value 8% semi-annual pay bond that is currently trading at a flat price of $82. Calculate the current yield. So the current yield is the annual coupon. Please note we don't compound here, divided by the price. The annual coupon will be 4 plus 4, $8 divided by 82, or the yield, that is the current yield, would be 8 divided by 82, that is equal to 9.76%. So please note that it's based on annual coupon. So the current yield will be the same for an annual pay bond or a semi-annual pay bond as long as the coupon rate and the price are the same. Consider a 10-year semi-annual pay 6% bond trading at $102 on January 1, 2014. The bond is callable according to the following schedule. So 5 years later it can be called at a price of 102, or 8 years later rather. 8 years later it can be called at a price of $100. Calculate the yield to maturity, the yield to first par call, and the yield to worst. So for the yield to maturity, we will not assume that the call gets exercised. So 10-year bond, N will be 20, PMT would be 3 since it's 6% semi-annual pay, 102, so gives us an indication that the par value is 100. FV is equal to 100. I by Y is what we have to calculate. The PV is given to be minus 102, that is the current price, or you have to pay $102 to acquire this bond. So let's solve. $20 is N, minus 102 as PV, $3 as PMT, $100 as FV and compute I by Y. So 2.86 is the semi-annual rate of interest. If we multiply this with 2, we will get the yield to maturity as 5.73%. To calculate the yield to first par call, what we assume is that the bond gets called back on the date. So 5 years later, that is at n equal to 10, we receive the $3 coupons only for the next 5 years. The bond gets called back, but of course we will get a future value of 102 because the call prices or the strike price is 102. The callable option means the issuer can call it back by paying us so much money. The PV is minus 102 and we can compute I by Y. So once again, press 10 and press N, press 3 and press PMT, minus 102 as PV, plus 102 as FV, and compute I by Y. Comes out to be 2.94118. We'll multiply it with 2 and we get the yield to first par call as 5.88. We can similarly compute the yield to the second call, that is 8 years later, N as 16, PMT as 6, FV as 100. Please note the second call price is $100 and PV is minus 102. We can again compute I by Y. So press 16 and press N, press 3 and press PMT, my apologies, not 6, press 100 and press FV, minus 102 as PMT and compute I by Y. My apologies, minus 102 as PV, so we'll do it once again. As PMT, so 16 as N, 102 minus as PV, 3 as PMT, 100 as FV, and compute I by Y. Multiply it with 2 to get the yield, which is 5.68. So we have the yield to maturity, that is 5.73. The yield to first par call is 5.88. Please note, my apologies, the first par call is the second call. The yield to first par call means the call happening at $100 or par value. So this will not be the yield to first par call, this will just be the yield to first call. So yield to first call comes out to be 5.88%. Yield to first par call comes out to be 5.68%. This is also the lowest yield, So in the worst case, this is what we can expect to happen, or the yield to worst based on the current circumstances. Verify calculations. We'll next understand the yield calculations for floating rate notes and money market instruments. So, floating rate notes, as we studied, generally have a quoted margin relative to a reference rate like the LIBOR. So, the coupon payment would be LIBOR plus 1% or LIBOR plus 40 basis points, something like that. The quoted margin has to be higher for issuers with more credit risk, that is, they have to give their investors more coupon. And it can even be negative for issuers that have low credit risk, especially lower than the banks that quote the LIBOR as we studied. The required margin, that is the discount rate on a floating rate note, may be greater than the quoted margin if the credit quality has decreased, or it may be lesser than the originally quoted margin if the credit quality has increased. Now please note that generally speaking, the price of a floating rate note is equal to its par value. The reason, very simple, is that the discount rate is equal to the coupon. As the coupon changes, the discount rate also changes because the coupon is LIBOR. However, for floating rate bonds with a quoted margin like this 1%, the discount rate may not always be equal to the coupon because this required margin may now have come down if the credit quality has improved. When you issued the bond, you promised a higher coupon, but now the required or the discount rate the margin has come down because the credit quality has improved and you don't need to give such a high return. If the credit quality has deteriorated, this quoted margin may have gone up further, so the discounting will happen at a higher rate than the coupon that you have promised. So because of this, there may be some yield or there may be some difference from the par value for a floating rate note. For money market instruments, we've already studied in the review of time value of money. Please watch that video again, and please see the bank discount yield, the bond equivalent yield, and the other yield, money market yield, other definitions that we studied. So it's the same quotation that will work in fixed income securities also. Money market instruments are generally discount instruments, that is, they don't pay any coupon. They are trading at a discount. They give the par value at maturity, and the maturity is normally less than 1 year. Let's do an example and understand the floating rate note yields better. A semi-annual $1,000 par floating rate note has 3 years to maturity. The reference rate is the 180-day LIBOR and the quoted margin is 80 basis points. The 180-day LIBOR today is 4% and the required discount margin has now gone down to 47 basis points, or rather 75 basis points from 80 basis points. So if all future coupons were based on the reference rate and the margin hasn't changed, or the margin had remained 80 basis points, then the value, as we discussed, would have been equal to the par value. Now what has happened is that the coupon rate is higher, that is 4 plus 0.8, 4.8 divided by 2, since 4% is the LIBOR today. So the coupon rate is 2.4%. However, the discount rate is only 2.375% because the discount margin has gone down to 75 basis points. In such a case, we will find that the floating rate note may have some deviation from its par value. So let's calculate. It's a 3-year note, so we'll enter N as 6. The discount rate as 2.375. Payment of 2.4% of $1,000 face value, let's assume, so will be 24. Face value of 1,000, and we can compute the present value, which will be slightly greater than the par value in this case because the quoted margin has gone down or the credit quality has improved. Hence, the price of the bond has gone up. Price of the bond going up essentially means the yield has come down. It has come down by that 5 bips, by which the credit quality has improved. Guys, are you there? Sanjay, Sunil? We'll once again visit the concept of the yield curve and study it in more detail this time. So, a yield curve shows the term structure of interest rates by displaying yields across different maturities, or the spot rates across different maturities. This is the concept that we studied when we said that individual cash flows may need to be discounted by a different rate. That spot rate or that discount rate is given by the yield curve. The spot curve is a yield curve for single payments in the future, such as zero coupon bonds or stripped treasury bonds or individual cash flows, as we studied. The par curve shows the coupon rates for bonds of various maturities that would result in bond prices equal to their par values. Or in other words, it gives us the yield to maturities of the different maturities, because the price of a bond will equal to the par value when the yield to maturity equals the coupon. So with this coupon, the discounting back at the current spot rates will give us the par value, or this coupon is the yield to maturity of the corresponding maturity bonds. We'll study in more detail. A forward curve is a yield curve composed of forward rates, that is the expectations of future rates, such as the 1 year rate that is expected 1 year later, or the 1 year rate 2 years later, or the 1 year rate 5 years later. So the forward rate has expectations of future short-term rates. Let's understand each of these in more detail. So the first concept that we studied was of the spot curve. That is the yield curve, as we say, for cash flows that are 1 year in the future, the rate is so much. 2 years in the future, the rate is so much. 3 years in the future, the rate is so much. So on and so forth. The par yield curve tells us that what is the coupon rate that a 2-year bond has to give, such that the value of that bond is equal to the par value. So the first curve was the spot curve. The second curve that we have drawn, the slight dotted line, is the par yield curve. So this is C1, C2, C3, so on and so forth. So with a coupon of C2, what is happening is that for a 2-year bond, C2 upon 1 plus S1, that is the 1-year spot rate, the 2-year spot rate, plus C2 upon 1 plus S2 to the power 2 is coming equal to the other C2 plus the face value upon 1 plus S2 to the power 2 is equal to the face value. So this is the coupon that will make a 3-year bond or a 3-year treasury bond trade equal to par value. So it is something like accumulation of these 3 spot rates, like the yield to maturity. And the third is the forward curve that will tell us the expectations of the 1-year rate 1 year from now. So this is the 1 year rate 2 years from now. This is the 1 year rate expected 3 years from now, so on and so forth. So these are some curves that may need to be analyzed and understood. We've understood the spot curve and use that in valuing our bonds, that is, discount each cash flow by the corresponding spot rate. We can now use the other curves also to value the bonds and to understand the concepts. We'll do some examples and understand it better. Forward rates, as we studied, are current lending or borrowing rates for short-term loans to be made in future periods. A spot rate for a maturity of n periods is the geometric mean of the forward rates over the n periods. The same relation can be used to solve for a forward rate given the spot rate for two different periods. Never mind this, we'll understand this with an example, it will be clearer then. To value a bond using forward rates, discount the cash flows from times 1 through n by the product of 1 plus each forward rate for the period 1 to n, and then sum them. Again, don't need to remember this. Once we understand the concept of forward rates with examples, this formula will become more automatic rather than you having to memorize it. If the current 1 year spot rate is 5%, the 1 year forward rate 1 year from today is 6%, and the 1 year forward rate 2 years from today is 7%. What is the 3 year spot rate? So let's depict it. Question says that the current 1 year spot rate is given. The 1 year rate 1 year from now is also given. And the 1 year rate 2 years from now is also given. 5, 6. What is spot rate? But we can calculate the 2 year spot rate today and the 3 year spot rate today. This is what we need to calculate. Now, let's understand once again what this forward rate means. What this means is that today itself, I can enter into an agreement with you to borrow or lend X dollars at the rate of 6% 1 year later for a period of 1 year. So 1 year rate 1 year from today means I can borrow for 1 year later, and today itself we can fix that rate. That borrowing will happen 1 year later, but that rate we have decided today. Similarly, the 1 year forward rate 2 years from today means that our borrowing or lending will happen 2 years later. It can be $100, can be $1 million. But the rate we have both decided today, and that rate is 7%. If the rate goes up, the borrower gains. If the rate goes down, the lender gains because he has already locked in 7%. We'll understand this in more detail when we study derivatives and forward contracts there. But for now, just understand that forward rate is a future borrowing or lending rate that has been locked in today at t equal to 0. Today itself we have locked in that 1 year later we will borrow or lend for 1 year, or 1 year later we will borrow or lend for 2 years. Now let's see how this information can help calculate the 3 year spot rate or the 2 year spot rate for that matter. Let's assume the 3 year spot rate is called S3. If I borrowed $15, for instance, for a period of 3 years, then how much would I have to pay at the end of 3 years? I would have to pay 15 into 1 plus S3 to the power 3. Since S3 is the rate, at the 3-year rate. If today I borrow for 3 years, I'll have to pay the 3-year rate. This rate is not known, but this is the amount that I'll have to pay after 3 years. The principal plus the interest. The 1-year spot rate is given to be 5%. Instead of borrowing for 3 years directly, can I just borrow $15 for a period of 1 year? But then 1 year later, I'll have to give back 15 into 1 plus 0.05. And I don't have the money 1 year later. I'm looking for a 3-year borrowing. If I borrow for 1 year, I'll have to give this much money. Today itself, at t equal to 0 itself, can I enter into an agreement that I will borrow this much money 1 year later for a period of 1 year? Yes, I can. The rate is given to be 6%. So this entire amount, 1 year later I have to pay back. I'll borrow again at the rate of 6%. So 1 year later I'll have to pay this much money, this entire amount. This also I don't have because I need a 3-year borrowing. So the entire amount I can borrow 2 years later for a period of 1 more year. I can do that at the rate of 7% because that is the 1 year rate 2 years from now. So I borrowed this entire amount. That means at the end of the 3rd year, I will have to pay this entire amount. Whether I borrow directly for 3 years and pay 15 into 1 plus S3 to the power 3, or I borrow for 1 year and then refinance for another 1 year, and then refinance the entire amount for another 1 year. In both cases, basically what I have assumed or what I have completed is a $15 borrowing for a period of 3 years. At the end of 3 years, in both cases, should I be having to pay the same amount of money when I return after 3 years? If one is lesser than the other, there will be an arbitrage opportunity. That is, nobody will take the other option. If this is cheaper, nobody will borrow in the forward market. Slowly the forward rates will start coming down. If the forward rates are cheaper, then nobody will borrow in the spot. Because in both cases you have accomplished an exact same 3-year borrowing. So this must be the same. And this is how we can calculate. So 1 plus S3 to the power 3, and this is the formula that previous statement explained, would be equal to 1 plus S1 plus 1 plus 1 year rate 1 year from now plus 1 plus 1 year rate 2 years from now. You don't have to remember any formula. If you do it from the logic that I've just explained, and once you do more questions, you'll understand it better. You'll be able to solve any question. So we can compute S3 as the cube root of 1.05 into 1.06 into 1.07 minus 1. Similarly, if the question asked us what is the 2-year spot rate, we could have similarly calculated it that 1 plus S2 square, a borrowing for 2 years, is the same as the borrowing for 1 year and refinancing for 1 more year. This is given to be 5% and this is given to be 6%. So we can similarly calculate S2 also. The 2-year spot rate can also be derived and the 3-year spot rate can also be derived. please solve and verify that the 3-year spot rate will come out to be 5.997%, or approximately 6%. Let's do one more example and understand and cement the concept better. The 2-period spot rate S2 is 9% and the 1-period spot rate S1 is 5%. Calculate the forward rate for one period from now. Again, the 2-period spot rate is given. So 1 plus S2 square is borrowing for 2 years is the same as borrowing for 1 year and refinancing for another. Or you can say 1 plus is equal to 1 plus 0.09 to the power 2 upon 1 plus 0.05, and you can calculate the 1-year rate 1 year from now comes out to be approximately 13.1524%. Instead of borrowing for 2 years, I can borrow for 1 year and then refinance for 1 more year 1 year later. Both should give me the same borrowing cost. Otherwise, there will be an arbitrage opportunity. You can similarly solve any combination. A 3-year borrowing can be given as 2-year borrowing. So borrow for 2 years. 2 years means S2 square, 1 plus S2 square, and then refinance for 1 more year. That is 2 years later, refinance for 1 year. So you'll get the 1-year rate 2 years from now. The current 1-year spot rate is 5%. S1 is given to be 5%. The 2-year spot rate is 9%. And the 3-year spot rate is also given. Calculate the 1-year forward rate 1 year from now and the 1-year forward rate 2 years from now. So please note the number of years from now will be written first. So 2 years from now, the 1-year rate. 3y, 2y would mean the 2-year rate 3 years from now. So on and so forth. So let's calculate. To calculate the 1-year rate 1 year from now, we'll just use S2 and S1. So 1 plus S2 square should be equal to 1 plus S1 into 1 plus the 1-year rate 1 year from now. For calculating the 2-year rate 1 year from now, we have many options. We can say that 1 plus S3 to the power 3 should be equal to 1 plus S1 into 1 plus the 1-year rate 1 year from now into 1 plus the 1-year rate 2 years from now. So rather than a 3-year borrowing, borrow 1 year, refinance another year, refinance another year. or you can say 1 plus s3 to the power 3 is equal to 1 plus s2 square into 1 plus 2y into 1y. Once you've solved the first equation, you will know the 1 year rate 1 year from now. So please verify that from both these methods you will get the same answer for the 2 year rate 1 year from now. That is, borrow for 2 years and then refinance for 1 more year. Both should give the same borrowing cost. So both give the same answer. That is 24.7%. Now once we've understood the previous concept, computing the value of a bond using forward rates becomes very easy. So instead of 1 plus s2 square, I can always write 1 plus s1 into 1 plus 1y into 1y. Instead of 1 plus s3 to the power 3, which is what I need for bond valuation, I can always correspondingly write the forward refinancing. So the current 1 year rate is 7%. The 1 year forward lending from time 1 to time 2, that is 1 year rate 1 year from now, is 8%. The 2 year rate, rather the 1 year rate 2 years from now, is 9%. Value a 3 year annual pay bond with an 8% coupon and a par value of $1,000. So the coupon is given to be 8%. So at t equal to 0 we want to compute the price. T equal to 1 we get $80. T equal to 2 we get $80 again. T equal to 3 we get 1080. Traditionally we've learned this has to be discounted back by the 1 year rate. This cash flow has to be discounted back by the 2 year rate. And this cash flow has to be discounted back by the 3 year rate. Now we've also learned that 1 plus s2 square can be written as 1 plus s1 into 1 plus 1y into 1y. 1 plus s3 cube can be written as 1 plus s1 into 1 plus the 1 year rate 1 year from now into 1 plus the 1 year rate 2 years from now. So we can apply any method and compute the value of the bond. So it's not really a formula. Once you've understood the concept, you don't need to remember any formula at all. What we've basically done is that a 3-year borrowing can be broken up into any number of refinancings. Borrow for 2 and refinance for 1. Borrow for 1, refinance for the second, refinance for the third. So they all are the same concept. So please verify. Value of the bond will come out to be 1001.41. Sanjay, are you there? Okay. I'm sorry, another 15 odd minutes. We'll just wind up one last concept. So the last concept that we'll study in bond valuation is that of yield spreads. So a yield spread is the difference between a bond's yield and a benchmark yield. If the benchmark is a government bond yield, the spread is known as the government spread or the G spread. If the benchmark is a swap rate, the spread is known as an interpolated spread or an I spread. We'll understand with more example how a spread is calculated. A zero volatility spread or Z spread is the percentage that must be added to each spot rate on the benchmark yield curve to make the present value of a bond or the present value of the cash flows of the bond equal to its price. And finally, an option adjusted spread is the Z spread minus the value of the call option. So let's understand all these spreads in more detail. So let's assume it's a 3-year 10% annual pay government bond. So the cash flows are 10, 10, 110, and the price of the government bond can be calculated as 1 plus the yield that is the first method, please remember, that we studied to calculate the price of the bond. There is in fact another way of calculating the price of the bond if the par yield is not known or the yield to maturity is not known. That is, discount the first cash flow by the 1-year spot rate, the second cash flow by the 2-year spot rate, and the third cash flow by the 3-year spot rate. Both methods will get us to the price of the government bond. Now let's assume that the second bond is also a 3-year 10% annual coupon. However, it is a corporate bond. So the cash flows are the same, however, what do you think that for the same cash flows, the price of the corporate bond will be higher or lower? The price of the corporate bond will be lower than the price of the government bond because there is credit risk or there is additional risk. So if the government bond was being discounted back by YG, you think the corporate bond would be discounted back by something higher or lower? Or you think the discount rate here will be slightly higher since the price is lower? The question asked is, how much higher? If you're comparing with the yield to maturity, then the slight amount that we will have to add to the yield of the government bond so as to get to the yield of the corporate bond, or so as to make the present value of the cash flows of the corporate bond equal to the price of the corporate bond, is called the yield spread or nominal spread. Please note, this spread essentially comes because the corporate bond has credit risk. Higher the spread, lower will be the price of the corporate bond, and generally higher is the credit risk or the probability of default. Government bonds theoretically cannot default because the government can print money and return its obligation. The corporate cannot print money. The corporate has to earn money. If the corporate doesn't earn money, he can default. Now, for the corporate bond, we can price it using the spot rates as well. But again, to each of the spot rates, we will have to add a spread, because the price of the corporate bond will be lower. The spread that has to be added to each of these spot rates so as to make the discounted back values of the cash flows equal to the price of the corporate bond is called the Z spread, or the zero volatility spread. So both the spreads, be it the yield spread or the nominal spread or the zero volatility spread, both are a measure of credit risk. Generally, if one spread goes up, the other spread will also go up. The interpretation of both the Z spread as well as the yield spread are exactly the same. A lot of times, the spread may be high not because of credit risk, but because the bond is a callable bond. If the bond is callable, then again the price will be low or yield will be high. But is this because of credit risk? No. It is because that bond can be called back by the issuer. None of the investors wants to pay a high price for it. So even for a callable bond, sometimes the Z spread can be very high. But this Z spread is not a measure of credit risk. It is a measure of option risk plus credit risk. Of course, credit risk will cause some spread, but there is additional spread coming because the price is further depressed because it is a callable bond. Issuer can call it back. Price can never go up beyond a limit, because $100, $102, as we did the example, the issuer can call the bond back. So in such a case, the Z spread is not just a representation of the option risk, So in order to get an understanding of the credit risk of the callable corporate bond, that is to strip out the impact of the option from the Z spread, what we do is that we use some other method to calculate the price of the option, and then we subtract the option cost from the Z spread such that the resultant spread is only a measure of credit risk, because whatever the spread was because of the call option we have reduced. So the Z spread minus the option cost is the option adjusted spread, that is purely a measure of the credit risk of the bond. So let's do one example. Please don't worry if you didn't understand this completely, because we'll be doing it in a lot more detail at level 2. They've just made a passing reference to option adjusted spread. They haven't explained it in detail, so don't worry. Just remember, option adjusted spread is the regular Z spread that you studied minus the option cost. It is purely a measure of the credit risk of the bond. The 1, 2 and 3 year spot rates on treasuries are 4%, 6% and 7% respectively. Consider a 3 year 10% annual coupon corporate bond trading at 95. The yield to maturity is 14%. And the yield to maturity of a 3 year treasury is 11%. Compute the G spread and the Z spread. G spread is the same as the yield spread or the nominal spread. So the G spread is very simple. It is the yield to maturity of our bond minus that of the treasury, which will be equal to 14 minus 11, that is 3%. The Z spread of the corporate bond will be a little more time consuming to calculate. So we will first have to depict the cash flows, then discount each of them back by the treasury rate, plus a Z spread that should make this discounted back value equal to 95. So it will be a trial and error method using which we can calculate the Z spread. This calculation will not come in the exam, but you know that it is that one amount that needs to be added to each of the spot rates so as to make the discounted back value of the cash flows equal to the price of the bond. So this is the G spread, and you can calculate the Z spread. So this calculation will normally be by trial and error, not really expected to be asked. Okay, that was about the review on bond valuation, and we'll continue with the review on fixed income securities next time. So thanks a lot, and see you next time.